The market has been spiking upwards lately, mostly on the back of a select few major companies in tech. But in this video, I'm going to be taking a look at some smaller companies that aren't running as red hot as big tech, because I think that despite the recent rise of the market, there are a lot of discounted securities that are continuing to go overlooked. Remember, trends are always changing, and what's considered trash today might turn out to be a big winner in the long run. So, in this episode, I'm going to be going through my top 3 stocks that are trading on the TSX to give you a look at some potentially hidden gems. My name is Paul, and so far I've invested $100 per month into Canadian securities for 29 months straight, with the intention of emulating the journey of a hypothetical Canadian who will never be able to max out their tax-free savings account. And I'm doing this series to try and show that by following a disciplined plan of investing $100 every month, the average Canadian will be able to achieve retirement and live happily off of their investments in financial freedom. The first stock that I'm going to touch on is MTY Food Group. They're a major restaurant company that owns 90 different brands that they franchise out within Canada, the United States, and abroad, including Cold Stone Creamery, Papa Murphy's, Wetzel's Pretzels, Famous Dave's Barbecue, The Village Inn, Baton Rouge, and many, many more. So, what makes MTY different than any of their other many competitors in the industry? Simply put, it's the price. You can't find a profitable restaurant stock that trades anywhere near the low multiples of MTY, which boasts a price to free cash flow of 6.38 when using the trailing 12-month numbers. Comparing that to some of the industry giants with slower and less consistent free cash flow growth, you more often than not are paying premium prices with free cash flow multiples in the 20s and 30s. Plus, MTY offers a modest quarterly dividend with an annual yield of roughly 2.4%, and there's plenty of room for that to grow, with a free cash flow payout ratio of under 24%, considerably lower than most of its peers. This low payout ratio paired with the strong free cash flow growth is why post-COVID, we've been getting very consistent 10% plus yearly dividend raises. That said, it probably wouldn't be so heavily discounted if everything were going perfectly, so there is some risk involved here, particularly regarding the debt. See, MTY has a fairly large debt pile amounting to about $1.27 billion, which has been getting paid off fairly quickly, but still is a lot for a company the size of MTY. On top of that, top-line revenues did slow down a bit last quarter, which sent the shares below the $50 mark. But the CEO did state that this was due to a one-time weather event that caused many of the restaurants to shut down, lose power, and overall experience less traffic. Now, that could be a valid reason, or this could be an attempt to kick the can down the road, and until we see next quarter's numbers, we can't exactly be sure of which. Noting that, there are also some positives to look forward to, specifically regarding the Famous Dave's banner, which has historically only had corporate stores, but management has confirmed that they are in the process of building out an accessible franchise model that should allow the already large brand to expand quickly and profitably. Anyway, since buying shares of MTY last month, the price has come down by a further 4%, ending the month at $46.94. So this is one that you're going to want to add to the watch list if you haven't already. The next security that I'm going to be talking about is an undervalued residential REIT that I've covered in depth in last month's video, so I'll be very brief when going over it here. The REIT in question is the Morguard North American Residential Real Estate Investment Trust, and it trades under the ticker symbol MRG on the TSX. Despite having increased by over 3.5% from where I purchased shares at last month, MRG is still supremely undervalued in my opinion. The price per share is still less than 1/3 of the net underlying value of its assets, and again, like MTY, this is a profitable, growing business that has been seeing strong rental growth and consistently high occupancy. And it also pays a monthly dividend, with an annual yield of 4.7%. But if you want more details on the Morguard North American Residential REIT, then I'd recommend going back and watching last month's video after this one. Last up, we have a company in the finance sector that has been on a tear and seemingly can't be stopped, and that company is goeasy. goeasy's business model involves offering easy to comprehend, flexible loans in a variety of categories to people who have below average credit scores. Since last month's video, GoEasy is up another 6.24% on the back of another really good quarter, where the company saw both revenue and net income growth in the range of 25%, as well as an increase to their total loans receivable of over $200 million. Plus, they expanded their point of sale merchant network to over 10,000 total merchants, with over 480 added in just this past quarter. This continued expansion brought in over 40,000 new customers, which sounds like a lot, but actually points to how selective the company has been in their underwriting, considering there were over 600,000 new loan applications submitted over the same time period. On top of that, more and more of the loans that are being written are secured with collateral, making the stock a safer and safer investment with each passing quarter, especially since the banks have also been writing loans much more conservatively over the past year, which has pushed a lot of the near-prime borrowers towards GoEasy's products. Naturally, this has led to a rise in the company's average weighted credit score per customer, which is now at an all-time high of 629. Thanks in part to the change in federal government regulations for maximum allowable APRs on loans and the federal government increasing interest rates to cut down on inflation, a lot of GoEasy's competitors have been getting disrupted, with one filing for insolvency over the past quarter and another 2 discussing business restructuring. These weaker competitors getting shaken out of the market has played a significant part in GoEasy acquiring new customers and winning market share. As for the downsides with the company, GoEasy has continued to take on debt in order to optimally grow the loan book and fund their expansion projects, like the recently released mobile app and the newly announced specialized credit card products. Plus, there was a slight uptick in net charge-offs and delinquencies, though these are still well within the projected range. So there's definitely a good bit of risk that needs to be assessed before investing in GoEasy. But this risk is why the company is trading at a PE ratio of about 12.6 while growing earnings at over 25% per year. Also, GoEasy is forecasting to achieve the high end of their guidance for 2024. And before moving on, it's worth noting that GoEasy does pay a quarterly dividend, which annually yields 2.42%. So this is definitely a stock to keep your eye on. All in all, May was a good month for the portfolio. With 2 of the 3 holdings performing well, I'm now only down $65.71, or 2.18%, on the $3,014.65 that I've invested, which does of course include the reinvested dividends. However, if I don't include the reinvested dividends as part of the book value, the portfolio is up $48.93 on the $2,900 that I've personally deposited into the Wealthsimple account. Taking a look at my portfolio versus the benchmarks, it becomes even clearer that May was very kind to investors, as all of the benchmark ETFs did make upwards moves. My portfolio, represented by the green line, had the second best 1-month performance. However, that was completely outshined by the S&P 500, which continued to perform exceptionally well, now peaking at nearly $900 in net gains on the $2,900 that was put in, which is more than double the goal line with the red stars that represents a 12% annualized rate of return. Historically, the S&P 500 has only returned about 10% per year. So the S&P 500 more than doubling the 12% annual return line really highlights just how strongly the market has been performing since the portfolio's creation back in January of 2022. Comparing that to my portfolio's performance, well, I'm in last place compared to every one of the other benchmarks by a good chunk of change, and my portfolio would need to grow by 12.6% just to catch up to the goal line. But with my portfolio's holdings comprised of the 3 securities that I outlined earlier in the video, I'm still of the belief that I'll surpass the goal line in the coming years, especially considering the cheap prices I'm getting on MRG and MTY shares right now, which I can't imagine will stay this cheap over the long run without there being some serious problems to justify that discount. So, like last month, those are going to be the two securities that I'm going to be investing in with this month's $100 plus the dividends earned in May, since goeasy's still a bit on the pricier side and a little bit more risky in my opinion. As you can see on my recording here, I successfully purchased 4 shares of the Morguard North American Residential REIT for $15.65 each, and 1.0408 shares of MTY Food Group at a cost basis of $48.41 per whole share, leaving my portfolio with no cash left over after my orders were filled. So, as of the market's close on Friday, June the 7th, the portfolio has 134 shares of the Morguard North American Residential REIT worth roughly $2,095, about 13.6 shares of MTY Food Group worth over $630, and the same 1.62 shares of goeasy, which are now worth about $313. Taking a look at the dividend tracking chart, in May, the portfolio smashed its previous record for total dividends earned within 1 month by over $1.30, bringing in $11.03, of which $7.71 came from Morguard's monthly distribution and $3.32 came from MTY's quarterly dividend payout. This month also marked the crossing of a major new milestone. We hit double-digit dividends for the first time. You'll love to see it. But these are still just baby steps, and there are decades of consistent investing ahead if this hypothetical Canadian investor ever plans to retire on $100 per month. But every step is important, and with this month's $11.03, we can afford to buy some nice flowers for someone in our life who deserves them. Because we definitely can't afford to take them out to eat. But we can't let that put a damper on what has been a great month. In fact, the cumulative dividend income earned so far for 2024 is $45.34, and that's more than a third of the way to the $130 goal for earned dividends in 2024. Unfortunately, June is projected to be the one slow month in the quarterly cycle, and I'm only expecting to receive $8.02 in distributions. That said, July and August should really come in strong and push us a lot closer towards the goal. Taking a look at the yield on cost, as of this moment, if I were to just leave the portfolio as it is and collect the dividends in cash for the next 12 months, assuming no additional dividend hikes or share purchases, I can now expect to receive $121.99, which is a 3.5% increase from what was expected last month, and the full portfolio's yield on contributed capital has once again increased by 1 basis point to 4.07%. And that concludes this episode. So, thank you all for watching, but before you go, please remember that this video is not financial advice and that I am not a financial advisor. This video was made entirely for the purpose of providing inspiration and insight into my personal investment decisions, and it should not be used as a substitute for doing your own research. This video does not have the information required to make good investment decisions on individual securities. So again, I am not a financial advisor. I'm just a Canadian who likes to invest and share my opinions with others. And in doing so, I hope that I was able to provide you with something of value. And if I did, then please consider sharing it with anyone else who may also benefit from it. Thank you for watching all the way to the end, and enjoy the rest of your day.